Good morning and welcome back to Almus Market Mornings. The narratives we have been discussing the last few days remains broadly unchanged. The war goes on. US more recently has been trying to get its allies involved but has been unsuccessful so far. Another high-profile Iranian security chief was taken out, but what we are also noticing from markets front is that this is becoming some kind of a new reality. Despite the war, risk assets are somewhat stabilizing, though at a lower level. Tomorrow, all of us in Asia will get to know the rate decision by Fed because of the war and rise in oil prices. US has already seen a rise in diesel prices, and a higher inflation scenario may keep the Fed from cutting rates further. Good morning, JK. Switching from war for a moment, what are we expecting from the Fed's decision tonight? I mean, there's no rate cut action expected from the markets, but what about the commentary?
Yeah, good morning, Swaraj. Yeah, slight distraction from the drumbeat of war news. We are now focusing on what central banks are up to. Of course, so no major surprises are expected. Reserve Bank of Australia, in fact, kicked off the central bank rates agenda yesterday by hiking rates by 0.25% as expected. But its comments were broadly hawkish, and he was also saying that the discussion in the meeting was not about the timing and not the direction of the policy. Basically, he's saying that it could be more upside for inflation as well as on the rates. Now, the key meeting next, of course, is the Fed meeting. Just before that, of course, we'll have also the Bank of Canada meeting, who are expected to keep the rates unchanged, but with an eye on the inflation developments. Now, Fed meeting, there's a near certainty of holding the rate at 3.5%. Of course, the focus will be on the oil price surge, the PCE inflation, which has recently pushed up to 3.1% on the core, and also, the labor market, which still seems overall resilient despite all the concerns that is raised. Other focus will be on the dot plot, Powell comments and commentary on the oil price that will be seen. Now, the recent data has suggested that inflation progress has stalled even before the American war on Middle East. The PCE core has risen to 3.1% in January. It had been 2.6% last April. So the war is likely to reinforce the consensus around holding the rate steady, and it would take them changing their view to drop, being widely annulled now. Rate cuts projection is almost going to be zero. In fact, it would take only three members to plot a no rate cut to see the consensus coming to no rate cut in 2026. Now, in the lead up to the meeting, we also have the producer price index data. It may be a calm before the storm, but last month the PPI data had come super hot. Now we also see, apart from PPI number, the retail inflation, how it is going to pan out is going to be very important, because just before the war, the US retail gasoline price was ruling around 2.9 to 3 per gallon, and it is now at 370 or 380 per gallon. It's a very sensitive issue, not just because of the overall consumer sentiment and the ramifications, but also because that eats into the budget inflation, overall inflation, and the rates projection going forward. Just to give you a perspective, no, you see during the Russian-Ukraine war in 2022, the price increase had been by 170 to $180, but that happened over a period of 3 months. Now, within 2 weeks, we are up about 80 cents. Now, the war is likely to be a prolonged one, and the supply chain issue is likely to remain very much in play, because the key route through which the ships pass for supplying oil to the world, the Hormuz Strait, is still under the control of the Iranian army. The efforts to get it opened with the support of US allies have met with a negative response. So I think we are in a position where we cannot be complacent on inflation, and dot plot, I think, is going to see zero rate cut in this year, and some members, even some analysts, even suggesting the next move could be a hike, but the timing is very much the matter of debate. Also, to give one more perspective, it was in February 22 when the Russia-Ukraine war started that the Fed started raising rates from a record low of 0.25%, and within the next 15 months, the rates had hit to 5.5%. So that's what the market should be aware of. So when you say the risk assets have been somewhat steadier, I think it's a very tentative, position. Markets are probably biding their time just ahead of the Fed meeting, and therefore one can expect more volatility going forward. Now, as far as other central banks are concerned, Bank of Japan is meeting tomorrow, immediately after the Fed decision, and no change is expected. But what is to be seen in Japan is that the wage growth is improving. Although it's uneven, inflation is above target, but it is also kind of demand driven. Again, their response to the oil price going up will be, along with the forward guidance, will be closely watched. Swiss National Bank is the only major bank where there is an easing bias. However, the consensus for any change to, this week is almost nil. The European Central Bank and the Bank of England also are meeting. ECB had been saying that they are in a good place and the rates will remain steady for much longer, but that is now threatened due to the war that has erupted, and they could well be on a hawkish comment or possible cautious comment from the ECB president, which the market could take as a possible rate hike in the year going forward. Bank of England, not long ago, at least 2 to 3 rate cuts were expected from them this year, but that again is under question because the way the inflation trajectory is going to pan out, notwithstanding the fact that UK's weak economy requires some monetary support as well. Now, finally, you can also see that the sentiment, German investor morale has clearly shown immediately after the war broke out how it impacts, because the indicator has fallen to minus 0.5% from 58.3 in last month. So this is the lowest reading since April 25, but the businesses have reacted very negatively in their outlook immediately after the outbreak of the war. So I think now markets are watching all this, and we may sit on their hands until these decisions are over, and how the central banks speak out in their meetings about the future prospects. That's very much the focus for the markets in the days ahead. As far as India is concerned, you see the uneasy thing. Of course, we all know that oil prices have risen from 60-70 range to now about 80 to 100 range. In fact, Brent has risen above 100 in the last 2 sessions and stayed above that whole of this week. Now, at the same time, the cost of crude for Indian refiners has actually jumped a staggering 93% since February 28th, because that is when the oil hit 136.56 per barrel for Indian basket crude, and that is eating into a huge margin, huge margin impact for the domestic oil producers. Now, apart from that, it has its implications for the domestic oil price, which has not been changed for the time being, and there could be squeeze on the foreign exchange reserves because our forex bill, if the oil remains even at this level or slightly lower, at least 20 to 25% extra oil bill is what markets are anticipating. There could be a negative impact on the BOP position apart from the current account as well. So RBI's current action of holding the rate around 90 to 50 is probably not seen as sustainable. It's a matter of time unless there is a sudden turn of the war to the slightly cooling side. then we could see some cool off, particularly because of the seasonal factor. There could be some inflows which can take care. But then as of now, outflows are dominating. We have had for the month about 9 billion of outflows from FIs, and for this year it has crossed 8 billion. I think at a time when we are looking at a higher import bill, these outflows are actually causing much more strain on the foreign exchange reserves and the demand supply position as well. So India is going to take a long time to get out of this difficult situation, unless there is a big U-turn on the geopolitical side. Thank you.
Thank you, JK. And yeah, from for the domestic side, it's a challenge. The rise in oil prices, it has structurally gone higher. We will be trading in the higher ranges, and that will sort of hit our current account and keep rupee on the weaker side. So that's the ongoing narrative domestically. But globally, this week we'll be focusing on the central bank decisions. Reserve Bank of Australia has already hiked rates. It's one of the first central banks in that cycle to be on the hawkish side. Bank of Canada expected to keep rates unchanged. Then we have the Fed. Again, rates would be unchanged. But again, the commentary would matter because PCE has inched up even before the war. So oil price rise will just reinforce the view to hold rates. Then we have got the BOJ, ECB, and the Bank of England. So all of these central banks up ahead, and that will sort of keep markets busy. We'll keep tracking it. Tomorrow is a holiday on account of Gudi Padwa, so we'll catch up on Friday with the fresh round of updates. Thanks for listening.